Chapter 7, Cash and Receivables. In this chapter, we are talking about the valuation of the first two assets reported in the balance sheet. Usually, the company report cash with the cash equivalents. Cash is very understandable. It is just dollar bill, coins, checks. These are available for payments or used in operations. While cash equivalents, they represent the very liquid short-term investments. So the company can turn these assets into cash very quickly without losing the value. Different from short-term investments, cash equivalent are those have the maturity no longer than 3 months. That's the cutoff. The example including the investment in the money market fund, treasury bill, and commercial papers. These can be converted into cash overnight, actually. So when you read the company's balance sheet, you always see the first item reported in the balance sheet is cash and cash equivalent, which represents the most liquid assets of a company. Here is a note regarding the cash equivalent of Walgreen Boots Alliance. It provides more information regarding the cash and cash equivalent. What are included? It includes cash on hand and highly liquid investments with original maturity of 3 months or less. This includes credit or debit card receivables. Usually, these receivables will be settled within a few days. The amount was 90 million, 127 million in the past 2 years. So these receivables represent the credit card balance. When the customer visits Walgreens, they use credit card to make purchase, and the credit card company usually withhold the amount for a few days, and then the payment will be sent to the Walgreens in a few days. So these are receivables since they will be settled within a few days, so they are classified as cash equivalents. So that's the notes to inform the investors what items are included in this account. Internal control, which is very important for the corporate financial reporting, operations, and compliance. And internal control actually is a series of procedures or mechanism that encourage the company's compliance to the policies and regulations. Also improve the company's operating efficiency and minimize errors, theft, and enhance the reliability and accuracy of financial information. After 2002, the passage of Sarbanes-Oxley Act, especially the Section 4.4, requires the public companies to document their internal control and assess their adequacy. Also, in their annual reports, auditors should express an opinion on the management's assertion regarding their internal control. The COSO, the Committee of Sponsoring Organization, also defined the internal control as a process designed to provide reasonable assurance regarding the achievement of objectives. Those objectives are effective and efficiency of operations, reliable of financial information, compliance with laws and regulations. The purpose of internal control, in summary, is to achieve these objectives. If we apply the internal control into cash. So here are internal control procedures for cash. First, cash receipts. The very important mechanism of internal control regarding cash receipts is separation of duties. Here is an example. Employees A open the mailbox and prepare the copies of listing all the checks received from the customer, including the amount and the payer's name. These checks will be handed to another employee, employee B. Employee B will take all these checks along with a copy of the list to the person who is responsible for depositing these checks into the bank account. And the second copy of the checklist is sent to the accounting department, where another different employee, employee C, will enter these cash inflow or cash receipts in the accounting records, or the employee C actually make the journal entries. That's the example of separation of duties. In general, if an employee is in charge of the money, he or she will not make a record. The separation of duty is a mechanism or procedures that prevent the loss of assets or the theft of cash, because cash is very vulnerable to theft. Internal control for the cash payments or disbursements. In general, all the payments should be made by check, not cash payments. All the expenditures should be authorized. And checks should be signed by authorized individuals. You can also see the separation of duties in the example of cash disbursements. The purpose is to prevent unauthorized payments, to ensure the disbursements are recorded properly. So here is a concept check for internal control. The answer is C. It's nothing to do with senior or junior employee. The other three are all correct. Separation of duties. The checks are signed by authorized individuals, and the payments must be made with checks rather than cash.